Yes, good morning, everyone. How are you today? Good morning, everyone. How are you? Are you able to hear me? They responded.
Is saying good morning.
Thank you very much. Great. So today I want us to go to something quite different. Of course, these theoretical areas like the environmental management accounting, these are areas that we shall be revisiting many times. But today, mentioned there for us, budgetary control, and variance analysis. Budgetary control 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 and variance analysis. Quite popular in our exams. But before I look at these budget issues, like what we call the flexible budget, zero-based budgets, incremental budgets, let us tackle the elephant in the room by looking at the variances. So mention their variance analysis. Variance analysis, and I would want you right away, if you can, could you kindly tell us what is a variance? 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 Ladies and gentlemen, to help us wake up and come to terms with what is happening today, tell us there straight away that a variance is a deviation. A variance is a deviation. A variance is a deviation between expected parameters, and actual, between expected parameters and actual performance. A variance is a deviation. It's a difference between what we expect and what actually occurs. Ladies and gentlemen, we have got 5 types of variances. There are 5 types of variances. There are 5 types of variances. 5 types of variances, full colon. We have what we call the material cost variance, and the material cost variance, we have got 2 components. The components of material cost variance are 2. We have got what we call material price variance, and then B, we have what we call the materials usage variance. 5 types of variances. And then number 2, ladies and gentlemen, we have what we call the labor cost variance. And the labor cost variance, we have got 2 components. We have the labor rate variance, and the labor efficiency variance. So it is important for us to capture this in form of the acronyms. This one will be calling it MPV. This one will be MUV. This one will be LRV. And then we have LEV, labor efficiency variance. From there we go to Roman 3. Roman 3, ladies and gentlemen, we have the variable cost, variable overhead, variable overhead, cost variance, variable overhead, cost variance. This variable overhead cost variance has got as well two children. Just like the others, variable overhead cost variance, we have got two children. We have what we call the variable overhead, variable overhead efficiency, variable overhead efficiency variance, variable overhead efficiency variance, and then B, we have what we call the variable overhead expenditure variance. By the way, are they able to see my board clearly? Are they able to see my board very clearly?
Yes.
Yeah, most of them are saying yes.
Yeah.
Thank you very much. Variable overhead, cost variance. We have got two children there. We must know this. And then number 4, if they are comfortable with this, now I can come and delete. Number 4, we have the fixed overhead. Number 4, we have the fixed overhead, cost variance. The fixed overhead cost variance, ladies and gentlemen, have got two components. We have the fixed overhead. We have the fixed overhead, that's number A, part A. Fixed overhead expenditure. And then lastly, B, the last one for fixed overhead, is what we call the fixed overhead volume. Variance. Yes.
Then is requesting you mwalimu unarabu na ndio majority wanaingia alafu. Someone saying mwalimu rudia ndio tumeingia juu ya delayed logins.
Okay, perhaps what we could do is to finish the fifth one, and then I will be able to repeat very fast. The fifth one is what we call the sales variances. We have the sales variances. So sales variances are also divided into two. We have the first one, ladies and gentlemen, A is what we call the sales price variance. And then B, we have the sales volume variance. How many are there now for me to know how many came in?
68.
Oh, by the way, most of them have just come in. Because when we checked last, there were 30.
Yeah. Most of them they met first. Yes. You can just proceed.
Okay, great. Now we got. Ako. material cost variance, we have the labor cost variance, we have the variable overhead cost variance, we have the fixed overhead cost variance, and then we have what we are calling here the sales variances, the sales variances. So for me to be able to repeat this very fast in a better way, which will be beneficial to everyone, I would want us to look at a past paper question, which is November 2017. November 2017, question number 3, boy. 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 Please always, these lengthy questions, start by reading the requirement. Always you read the requirement. So November 2017, question number 3, boy. Question number 3, boy. Required, they want us to give them the operating variances. And then a statement reconciling the actual profit and the budgeted profit for the Wood Master Limited. So they want us to give them operating variances. And then number 2, a reconciliation statement. An examiner who tells you to prepare a reconciliation statement is an examiner who wants you to calculate all the 5 types of variances. They want us to calculate all the 5 types of variances, of which I'll begin with the material cost variance. So material cost variance, and the material cost variance, I will begin with this, and the materials mentioned there, material cost variances. And the material cost variances, we will begin with material price variance. Material price variance, material price variance. The difference between 2 prices. I told you when we began that a variance is the difference between an expectation and an actual outcome. So at the beginning of the period, we had an expectation in terms of price. It's a price variation. The expected price, of course, will be called what here, the standard price, what we expect we shall use, we shall incur to procure our raw materials. We call this one the standard price. Minus the actual outcome, this will be AP, actual price, And then, of course, this variance that you have here will be a variance for 1 kilogram, for example, and yet I want total. I want the total. So what I need to do is to come here and multiply outside here with the actual quantity that was done what here, that was purchased, with the actual quantity that was purchased. So we have here the difference between the variances inside brackets here, difference between 2 prices, standard price minus actual price, into actual quantity that was done what here, that was purchased. So please write in full that this SP is the standard price per kilogram. SP is the standard price per kilogram, and then we have AP, which is the actual price per kilogram, And then we have AQ. AQ is the actual quantity that was purchased. Actual quantity purchased. So now in the question that we have, which we want now to read, we are told, Wood Master, I'm reading this question from the beginning. Wood Master Limited makes quality wooden benches both for indoor and outdoor use. Results have been disappointing in recent years, and a new managing director has been appointed in order to boost the production volumes. After an initial assessment, the director has noted that the budgets had been set at an easily achievable level for employees. He argues that employees would be better motivated by setting budgets that challenged them more in terms of a higher expected output other than changing the overall budgeted output. The director has not yet altered the standard cost card. The budgeted output and the sales for the month of October 2017, was 4,000 benches. Please underline for me the following sentence. The following sentence here, which reads the standard cost card. Those 4 words should be underlined. The standard cost card, because there is no way you can ever do any variances question without a standard. So for you to be able to tackle any variances question, you need a standard, and then number two, you need actual. You need actual, a standard and actual like that. So ladies and gentlemen, if that is the case, after you guys have underlined that, we are told the standard cost card at this output level is provided below. So you can see wood, 25 kilograms at shillings 32 per kilogram, which is 800. Labor, variable overheads, fixed overheads, total standard cost. And then we have the selling price, and lastly, the standard profit. So all those are standard parameters. Additional information, overheads are absorbed on the basis of labor hours, and the company uses an absorption costing system. 2, stocks are valued at standard cost. There were no stocks at the beginning of the month of October 2017. 3, actual results for the month of October 2017 were as follows. So please again underline note 3, actual results. There is no way you will ever do a variances question without the standard, without the actual. So they have given us the actual results there. Note number 4, the average monthly production and the sales for some years prior to October 2017 had been 3,400 units, and the budgets had previously been set at this level. Very few operating variances had historically been generated by the standard cost used. 5, the finance director suggested that an absorption costing system is misleading and that marginal costing system should be considered at some stage in the future to guide decision making. Now they want us to give them operating variances, and I've told you you've got 5 types of variances, of which the first one that we want to compute here is the material cost variance. This material cost variance is divided into 2. We have the material price, and then we have the material usage variance. Now, my great students, I want us to get this material price variance. Remember what is our raw material here? It is wood. Our raw material is wood. So I would want to know the standard price per kilogram of this wood. The standard price, I'll throw my eyes to the standard cost card. Go to the standard cost card. I'll throw my eyes very fast there to the standard cost card. Under the standard cost card, ladies and gentlemen, I can see here, under the standard cost card, I can see here, under the standard cost card, 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 I can see wood. Wood, how many kilograms of wood here under the standard cost card? I can see 25 kilograms. I can see 25 kilograms, each kilogram going for 32. Each kilogram going for 32. Each kilogram going for 32, giving me a total of shillings 800. A total of shillings 800. Now, ladies and gentlemen, please never confuse and work with this 800 here. Because my SP stands for standard price for 1 kilogram. And the standard price here for 1 kilogram, each kilogram is going for 32. So the standard price is 32. The standard price is 32 there. Straight away, throw your eyes to the actual, because AP stands for the actual price per kilogram. So go to the actual information table given on note number 3. Given on note number 3, the actual. They have given us actual information. They have given us here actual info. Under the actual information, ladies and gentlemen, the first item there, whose analysis I'm doing, they have given me there wood. Wood, how many kgs? 800,000. 800,000 kgs. Each at how much? Each at how much? Each at 35. Each at 35. So what do I want? Here I want the actual price per kilogram. From the actual information given, I can see the actual price here is 35. So 32 minus 35, like that. I'm not releasing my eyes from the actual information. From the actual information, again, they want me to pick the actual quantity of wood which I purchased. The actual quantity of wood that I purchased, I can see from the actual information, is 800,000. So get your calculator and give us this figure. Get your calculator and give us that variance. So what we have there on, we have 32 minus 35 equals first. Whatever I get, I say times 800,000. I'm able to see 200 and something, eh?
There is a correction.
A correction, yeah?
It's 80,000, not 800,000.
It's 80,000, eh? Yeah, I'm able to see. I was looking at this from my distance. This is supposed to be 80,000. Please do that correction, everybody. It's supposed to be 80,000. So 80,000. So repeat again. So 32 minus 35. That gives me minus 3 times 80,000, which will end up giving me 240,000 negative. But remember, in variances, you don't talk of negative. Anytime you get a negative variance means a loss for you. It means a loss for you. And all loss variances are supposed to be designated as what here? As adverse. All loss variances are supposed to be designated as adverse. The argument being, we were prepared to procure this timber at 32. But along the way, things changed. Timber became expensive. We ended up buying it at a higher price. That can't make us happy. No. That will make us sad. Automatically, the moment in terms of cost, we exceed the price we intended to buy these things at, that makes a situation worse for us. That complicates things for us. The very best way of knowing this is that all negative variances are supposed to be taken as what here? Adverse. There are exceptions, but I'll be telling you later where, or rather, which exceptions will we be looking at. That will be later. Now, I hope this is clear. And if it is clear, help me, in this case, ladies and gentlemen, to compute the second component of material cost variance. Remember, we said material cost variance, we've got how many components? 2. We've got how many components? 2. The first one is the material price, and now we have the material usage variance. Material usage variance. Material usage variance. For material usage variance, I hope you guys have written these in full. Usage variance is a quantity variance. There is that quantity that we expected to use, what we call the standard quantity. What we call the standard quantity, minus in this case here, what we actually used. What we call the actual quantity. Ladies and gentlemen, this will be a quantity difference. But you see, at the end of the day, we must monetize. We must change this to money. So come and multiply outside here with what here? The standard price. Material usage variance. I was prepared to use this particular quantity of timber, but I ended up using more or less. So ladies and gentlemen, usage variance. As we started, we said a variance is a deviation between an expected value vis-a-vis an actual outcome. Between an expected value, a standard, between an expected value and an actual outcome. Once I appreciate that definition, then I'll be good to go as pertains to what here? Variance analysis, as pertains to variance analysis. So ladies and gentlemen, I would want us to define these things very well. This material, this MUV stands for material usage variance. This stands for material usage variance. MUV stands for material usage variance, material usage variance. And then, of course, we have this capital SQ. The moment I understand this, then automatically I've understood the entire variances. This is what confuses very many students. This SQ stands for what in full? Cause not servant quarters. SQ stands for standard quantity for actual production. Standard quantity for actual production. Please write that in full. Standard quantity for the actual number of units that were produced. Standard quantity for the actual number of units that were produced. And then we have a Q. This is the actual quantity used. Actual quantity used. Actual quantity used. This AQ stands for actual quantity that was done what year that was used. Actual quantity that was used. And then we have SP. SP stands for standard price. We've written this up there. SP stands for standard price per kilogram. 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 Now, ladies and gentlemen, I would want you to listen and listen to me very well. What I've told you to go and mark, what I would want you to mark, and you mark very well, is this capital SQ. Once you appreciate what capital Q stands for, then you will never go wrong. You will never go wrong. Capital SQ, I want to emphasize again. I want to emphasize again that this capital SQ stands for standard quantity for actual production. Standard quantity for the actual units produced, for actual production. For actual production. And this is AQ, actual quantity done what here? Used. Actual quantity used. Actual quantity used. And then of course we have the standard price per kilogram. Standard price per kilogram. Now, ladies and gentlemen, kindly let us go to our standard cost card. Our standard cost card. I'm able to see from our standard cost card what quantity is standard. Standard cost card, I can see the quantity that is standard, quantity of wood. When we are computing material cost variances, the quantity of wood which is standard is 25 kgs. But you see, standard means what? Standard means per unit of output. The output, ladies and gentlemen, here, we are producing benches. So I would want to go through my question here to see how many benches we produced at the end of the day. So the actual production, or the actual output equals what? Who is able to tell us, ladies and gentlemen, this morning, how many units do we produce at the end of the day? How many benches? What is the actual production? What is the actual production for the question that we have? Actual means that we throw our eyes to the actual information. From the actual information, we shall be able to get the actual output. Out of this wood, we're able to carve this wood very well, and we were producing benches. So for the period that has just ended, how many units do we actually procure?
Some are saying 3,600, then others are saying 4,000.
4,000, and others are saying 3,600. Let us try to capture this information, and we capture it very well. Ladies and gentlemen, you're saying others are saying?
4,000.
4,000?
Others are saying 3,600.
3,600. Now, ladies and gentlemen, let us see where this 4,000 is coming from. The 4,000 that some students are mentioning to us is coming from paragraph number 2 of this question. Paragraph number 2 of this question, we are told, after an initial assessment, the director has noted that the budgets had been set at an easily achievable level for employees. He argues that employees would be better motivated by setting budgets that challenge them more in terms of a higher expected output other than changing the overall budget and output. The director has not yet altered the standard cost card. Look at that output. That output is budgeted. The budget of the output and the sales for the month of October 2017 was 4,000 benches. So the 4,000 that you guys are giving me, some of you are giving me, is budgeted. But for me to get standard quantity here, I need the actual output. The actual output from note number 3, which talks about actual information, note number 3, which talks about actual information, I'm able to see an element of total production. The total production cost, where we are able to see that we produced 3,600 benches. We produced 3,600 what year? Benches. Where we had a closing stock of 400 benches, meaning that we sold 3,200 benches. So the actual production, ladies and gentlemen, The actual production, the actual output was 3,600. 3,600. Therefore, this will be 25. Always remember that for standard quantity, we must always pick a quantity from the standard card and then we multiply it with what? With the actual output. With the actual output, which in this case here I'm told was 3,600. Actual output in full. This is standard quantity for the actual number of units that were done what year that were produced. Standard quantity for the actual number of units that were produced minus the actual quantity that was used. Ladies and gentlemen, actual quantity of what? Don't pick the actual production. Here it's about usage. It's about the wood quantity we used. The actual kilograms of wood that we use, ladies and gentlemen, are given here. The actual kilograms of wood we used, if you throw your eyes to the actual information, you'll be able to see that we actually used 800,000. 800,000 times the standard price of wood per kilogram. So go to the standard cost card, you'll be able to see an element of wood. You'll be able to see an element of wood here, 25 kilograms, each at Kenya shillings 32, the standard cost card, each at shillings 32, each at shillings 32. So could you kindly give us a figure? Could you kindly give us a figure? Could you kindly give us a figure there? I'm picking every time 800,000. I don't know why. I'll have to get used to this. It's supposed to be 80,000 units, 80,000 kilograms of wood. Sorry for that. Perhaps I'm thinking it's money. Money, they have more, the better. The more, the better. It's supposed to be 80,000. This one's here, 80,000 kilograms. So times 32. What figure are they getting? Somebody there?
320,000.
I'm being given, ladies and gentlemen, a figure of 320,000. But you see, this is variance. If it's a variance, you must tell us what type of variance do you have. Is it a favorable variance or a diverse variance? If it's positive, that is a variance which has impacted positively on your bottom line, positively on your profits. So positive means that it favors you. So then this will be 320,000 favorable. Any question, my great students? Standard quantity for actual production. Standard quantity for actual production. Standard quantity for actual production. Standard quantity for actual production.
Osi was asking, why are we multiplying 25 with 3,600?
Okay. Now, ladies and gentlemen, that is quite a straightforward question. Listen and listen to me. This is supposed to be standard quantity for the actual number of benches that we produced. So if you go and pick, for example, the standard quantity of 25, standard quantity of wood of 25, just pick it the way it is, 25. And then you say minus the actual quantity that was done what year you used. You can see the two figures will really not matter. How do you plan to use only 25 units, and then you end up using 80,000? There will be a big mismatch there. And that is why we said that this standard quantity has always to be reflective of the actual production. If you see this, we are saying it is standard quantity for actual production. So you take the 25 there, which is the material, the wood we need per bench, times the actual number of benches that we did what year that we produced in the period. So times what year? 36. Anytime you see standard quantity, standard hours, always the actual production must be used somewhere. So Mercy, I have tried my best to answer you.
Kasuki Mwana was saying, how did you go to the actual production?
The actual production is given in the actual note. This actual information given on note number 3. Note number 3 of this question, November 2017, question number 3. Or rather note number 3, yeah? It's also question 3. It's question 3, note 3. And note 3 will be able to see the income statement. Under this income statement, you will see wood, labor, variable overhead, fixed overhead. And then we have a place where they're talking of total production cost into brackets, 3,600 benches. That's how I was able to get my actual number of benches produced as 3,600. Any other question? Thank you very much. Now we are through with the materials. Once you are through with the materials, the next item that you need to think about is labor. The materials have come into the house. We need people to convert these materials now into finished output. So we need labor. We need labor. So labor, ladies and gentlemen, we have here labor cost variances. Labor cost variances, they are of two types. We have labor rate variance and the labor efficiency variance. 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 Now, ladies and gentlemen, for labor rate variance, which I hope you have written in full, this is labor rate variance. Labor rate variance. For labor rate variance, we are talking of what variance? Variance between two rates. The rate that we thought we would have incurred, would have used while paying our workers. We had to put it up there, 1,000 maybe per hour, or 2,000 per hour, up there. But boom, COVID-19 comes, spoils the party for us. Now that we don't want to send our employees home with nothing, what will happen is that we have to reduce their rate. So then we have a difference between the standard and the actual. So anytime we talk about labor rate variance, it is variance between two rates. Which rates are these? We have the standard rate minus the actual rate. And then outside here, we have what we call the actual what here? The actual hours. The actual hours. So we have the standard rate minus actual rate multiplied by actual hours. Difference between two rates. That is our labor rate variance. So we have our SR. This SR stands for the standard rate per hour. Standard rate per hour. We have AR standing for actual rate per hour. Actual rate per hour. Actual rate per hour. So if that is the case, ladies and gentlemen, of course, AH stands for actual hours. Actual hours paid. Actual hours paid. So come and give us the labor rate variance. Give us the labor rate variance. Give us the labor rate variance. So what I will do, I'll go to my standard cost card first, because they want us to start with the standard. So go to my standard cost card, which is given up there before additional information. The standard cost card as regards to labor, this is what we have. As regards to labor, we have 4 hours at shillings 80 per hour. Shillings 80 per hour, giving us a useless thing here of 320. Not make use of this. 320. And then in the actual information, actual table, they have given me their labor. So what do they have there? Labor from note number 3. From note number 3, we have labor of 16,000 hours, labor of 16,000 hours, labor of 16,000 hours at shilling 70 per hour, at shilling 70 per hour, at shilling 70 per hour, at shilling 70 per hour. Now come here, labor rate variance, the formula is here. Pick the standard rate. Go to the standard cost card and pick the rate per hour. The standard rate per hour of labor is shillings 80 per hour. So we have here 80 minus actual rate. Go to the actual information and pick the actual rate. Actual rate of paying workers here was 70. Multiplied by outside here. Actual hours, I will throw my eyes to the actual information Actual information is here. So come and pick the actual number of hours, which were what here? 16,000. 16,000. So we have here times 16,000. Could you kindly give me this answer? I like variances for two reasons. Number one, it must be there in your exams. That's the major reason. And then number two, once I do one question, and then of course I'm a hardworking student, I'll be able to master all the formulas in the shortest possible time. So what are they getting?
Correction. It's 160,000.
Oh, it's 160,000.
Yeah.
Why am I picking figures wrongly today? Why are we picking figures wrongly today? So I'm being told, ladies and gentlemen, that for labor from the past paper, labor is supposed to be talking over 160,000. Most of them are saying 160,000.
I'm saying 160,000 F.
Oh, not correction. The final answer.
Yeah.
The final answer. This is the final answer. So final answer, they are saying is 160,000 positive. So if it's positive, we have here favorable. Favorable. Why are we saying favorable? Because as a company, we had prepared to pay our workers at 80. But we ended up actually paying them at 70, which is a lower rate. So we are well within our budget. So we saved for the company. But we normally don't like going into such arguments. The best thing is to know that if the final variance is positive, then it is automatically what here? It's automatically favorable. It's automatically favorable. Very good. So if you allow me, straight away I'll go to the second component of labor cost variance called labor efficiency variance. So we have here labor efficiency variance. We have number two, labor efficiency variance. Labor efficiency variance. So labor efficiency variance. Labor efficiency variance. Labor efficiency variance. Ladies and gentlemen, every time they talk about labor efficiency, I'll always remember one tribe in Kenya here, which is very efficient in whatever that they do. Very efficient in whatever that they do. How they organize their things. They're very orderly, right? Indians. And of course, in this case here, not all Indians, but a particular, especially the Shah community. The Shah community. So every time they talk about any type of efficiency, always remember my friend from this community called Mr. Who? Mr. Shah.
Yes. Can I unmute?
Yes. Yeah, someone has raised a hand there, so we are unmuting you so you can talk to us. We are not able to hear you. Please, once you raise your hand, we unmute you and then talk to us very fast. You can just continue. Thank you very much. Okay. Very good. So please remember that is quite an important feature that you have there. If you want to talk to us, you simply raise your hand there. And then once we unmute you, you talk. Don't fear anybody. You talk. So efficiency, I've just said here that the people who are very efficient are what here? Indians, especially Indians from the Shah community. Mwingi yote ambao anaitwa Shah, huyo ni hatari sana. Shah. Wale ambao mwafanyia kazi mnajua how strict they are. But you see that strictness enables them to create businesses which are able to transcend seasons, are able to transcend generations. For us, what we do, we will come and create, for example, you've created this kind of a business, you hype it very fast, you do very well, get millions. Once you die, everything again dies with you. So when we talk of labor efficiency, so long as you have the word efficiency, always remember that in brackets we have Mr. Who? Mr. Shah. Efficiency. Always remember that we have Mr. Shah. And then outside here, we'll be talking of what here? SR. Where SH stands for standard hours for actual production. 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 This SH, I'm repeating again. It stands for standard hours for actual production. Standard hours for actual production. Standard hours for actual production. And then, of course, we have AH. This is actual hours, actual hours, actual labor hours, actual labor hours, actual labor hours. And then we have SR being the standard rate per hour. The standard rate per what year? Per hour. Standard rate per hour. Standard rate per hour. Standard rate per hour. Standard rate per hour. So I want us to plug in figures, and before I plug in any figure, I would want some good student to try it out, giving us the labor efficiency variance by plugging in the figures themselves. They give me the answer so that I can assess whether these students are following what I'm doing. We want to assess. Labor efficiency variance. We want to see whether there is any student who will be able to get this right.
Is giving 4 times 3,600.
Okay, great. Great, very good hint.
Karuki for what? 3,600. Then very Wambui.
Thank you very much. Thank you very much. Ladies and gentlemen, for standard hours, I'll go to my standard cost card and pick the hours here and the labor. So labor, we have got 4 hours. But remember, whenever the examiner talks of standard, the actual output must be involved. So standard, take the hours given here times the actual output. The actual number of benches we produced here were 3,600. 3,600. Minus the actual hours, we throw our eyes here to the actual hours. Actual hours were how many? 16,000. From the actual information, actual hours here were 16,000. So 16,000 are multiplied by the standard rate per hour. Look at the standard cost curve. The standard rate per hour, what do we have here, somebody? We have 80. Standard rate per hour is 80. So could you kindly give me the final answer? And tell me whether it's favorable or adverse. Is it favorable or adverse?
Previously, they got 128,000 A.
128,000, eh?
Yeah.
A for what here? For adverse. A for adverse. That in this case here, we had budgeted for these people here to work a certain number of hours, but they ended up working in this case here more, for more hours than the plan. So then that means that we overpaid them. So then that automatically gives us what we call an adverse variance. Any question before I go to the variable overheads? Any question before I go to the variable overheads? We are almost there. You guys are strong. We are almost there. You guys are strong. So variable overhead cost variance. Variable overhead cost variances. So this again is divided into 2. It's divided into 2. We have the variable overhead efficiency and the variable overhead expenditure and the variable overhead expenditure. Variable overhead efficiency and the variable overhead what here? Expenditure variance, of which I would want us to start with the first type of variable overhead cost variance, what we are calling the variable overhead efficiency variance. I would want to hear, ladies and gentlemen, whether there is anybody who will be able to put the correct things in brackets here. What am I going to have in brackets, ladies and gentlemen? In my brackets there, what am I going to have? So long as we have the word efficiency in a variance, I'll always remember my best friend from that community called Mr. Who? Mr. Shah, my best friend from that community called Mr. Shah. Mr. Shah. So long as it has efficiency there. And then outside here, I'll have what we call, of course, I can't have SI. These are variable overheads. So we'll talk of standard variable overheads per hour. 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 So this SH stands for standard what year? Hours for actual production. Standard hours for actual production. Standard hours for actual production. Anytime I see capital SH, I always remember to use here the actual output or actual production. AH, of course, I don't have to emphasize, these are the actual labor hours. These are the actual labor hours. Actual labor hours. And then we have SVO per hour. This will be the standard variable overhead. The standard variable overhead per hour. The standard variable. The standard variable overhead per hour. The standard variable overhead per hour. The standard variable overhead. The standard variable overhead per what year? Per hour. Per hour. The standard variable overhead per hour. Now you guys have even gone a step further and became even brighter than myself. And because of that, I expect somebody to do some proper substitutions there and give me the variable overhead efficiency variance. Let us see whether they'll be able to get it right. Please plug in. I'm just trying to involve you. I'm trying to involve you. You know, one thing that you're going to realize is that these online classes are more effective than the brick and the mortar classes. They are more effective. They are more effective. And we'll be telling you why. I'll be telling you why these classes are more effective. More effective. More effective.
Miriam, Geoffrey.
Geoffrey, the first one who got it right is?
Mary.
Mary. Mary, Geoffrey, what are they getting?
64,000 A.
64,000 A. 64,000 A. 64,000 A. But you see, those are only 2 students. Eh? How many students do I have in that classroom, by the way, in this classroom?
There are remaining 92.
92, eh? Okay. So then what do we have here? What we have, ladies and gentlemen, here, we are talking of standard hours for actual output. And remember, we are looking at variable overheads. We are looking at variable overheads. When you go to the standard cost card, you'll be able to see variable overheads. Variable overheads. Variable overheads. Into brackets here, what do we have? Variable overheads. Into brackets, we have 4 hours, each at 40. So we have 4 hours, each at shillings 40 per hour. Each at shillings 40 per hour. Each at shillings 40 per hour. So in terms of variable overheads, my standard hours, just like the labor hours were 4. But remember, if it is capital SH, we must involve the actual production. So multiply this with 3,600. 3,600 minus the actual hours. These are the normal actual labor hours. The normal actual labor hours that you guys gave me a figure of 16,000. You guys gave me a figure of 16,000. Multiplied by the standard variable. So again, go to the standard variable overhead, go to the standard cost card. The standard cost card, I can see variable overhead, 4 hours, each at a standard cost of shillings 40 per hour. So times 40, times 40, times 40. So then at the end of the day, I want to imagine those students, ladies and gentlemen, who gave me that figure were correct. What figure were they giving us?
64,000 at least.
64,000?
Majority have given that.
Majority, yeah. 64,000 adverse or favorable?
Adverse.
A, adverse. Thank you very much. Adverse. adverse. Remember, this is the first component of variable overhead cost variance. We have another component of variable overhead cost variance called variable overhead expenditure. Variable overhead expenditure variance. Variable overhead expenditure variance. Variable overhead expenditure variance. Variable overhead. So variable overhead expenditure variance.
Question answers question.
Yes.
Someone help where we are getting 40.
40 Bobe is standard variable, the word standard variable overheads per hour. Go to your standard cost card given there, you'll be able to see variable overhead standard 4 hours, it's at 40 per hour. Each at 40 per hour. Just look at your past papers well. Look at your past paper well. Look at your past paper well. Look at your past paper well. So variable overhead expenditure variance. Variable overhead expenditure variance. Variable overhead expenditure variance. So for expenditure variance, this is a little bit different from the others, but also it's an easy one. Normally what we do for us to be able to get variable overhead expenditure variance is to take the standard variable overhead per hour times actual hours minus this bad fruit. Fortunately, it's disappearing from the market. Avocado. You're fighting weight, but they normally say it's good, but I don't trust it. Avocado. So standard variable overheads per hour times actual hours minus actual variable overhead. So this, of course, you guys know it is standard variable overhead per hour. And then we have AVO is actual variable overhead. Is actual variable overhead like that. Actual variable overhead like that. So ladies and gentlemen, I would want somebody to try plugging in the figures, and then you ensure that we have the variable overhead expenditure variance. You ensure that we have the variable overhead expenditure variance. Variable overhead expenditure variance. Somebody pick up those figures from the information that you have, plug them in, try to multiply for us, and then of course you subtract there at the end of the day. Give us an answer. Give us an answer. So what do we have, ladies and gentlemen, for the standard variable overheads per hour? Standard variable overheads per hour, we have 40 multiplied, or they have an answer, multiplied by the actual hours that you guys gave me 16,000 minus the actual variable overhead, actual variable overhead, ladies and gentlemen, the actual. If you go to the actual statement given in note number 3, you'll be able to see the actual variable overhead there was 600,000. The actual variable overhead was 600,000. 600,000, of course, 600, but I have to turn the zeros to be consistent, or I chop these 3 zeros. So if you multiply and subtract, what figure will we get? Yes?
So we are getting 40,000 F.
40,000 F. F for what year? Favorable. F for favorable. 40,000 favorable. 40,000 favorable. Great, 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 great. So I would want to continue, but before I continue, what do you think? Can we have a break of say 3 minutes? Or you guys are okay, we continue? A break of say 3 minutes, or we just continue? Break, it's important. Yeah, I know where we have reached. I would want you to take a break and, of course, have a deep breath. Very important. Breathe deeply, and then we come back after 3 minutes.
Please complaining about bundles.
Oh, bundles, eh?
But what you are saying, you have a break.
Break is important. Sorry for that. I can buy you a few bundles, eh? So great, welcome back, and I'm so sure now you are fresh. Now we should be able to finish this question very, very well, very easily. Now, our next type of variance, ladies and gentlemen, is called the fixed overhead cost variances. So mentioned there, the fixed overhead cost variance, fixed overhead cost variance, fixed overhead cost variance. Fixed overhead cost variance has got two children. Fixed overhead cost variance. So fixed overhead cost variance, we have what we call the fixed overhead expenditure variance, fixed overhead expenditure variance, fixed overhead expenditure variance. So ladies and gentlemen, how do I get this fixed overhead expenditure variance? Whenever they talk about fixed overhead expenditure variance, I always remember my great friends in politics, or rather the people that I can never forget in politics. From Luya Nation, before the minus, don't know. So anytime they talk about fixed overhead expenditure variance, I'll always be taking budgeted fixed overheads minus actual fixed overheads. Budgeted fixed overheads minus actual fixed overheads. Budgeted fixed overheads minus actual fixed overheads. So in this question, ladies and gentlemen, I'm repeating again for purpose of you capturing this nicely. BFO, the one I've called before, he was a great politician sometime back. Budgeted fixed overhead. In this question, who is able to see the budgeted fixed overhead? Budgeted fixed overhead. So go back to your standard card. Go back to your standard card. You can see fixed overheads per unit. Fixed overheads in the card here. Fixed overheads. I can see some number of hours there. Fixed overheads, I can see some number of hours there. We have 4 hours at 160 per hour. So we have 4 hours at 160 per hour, giving us a total of 640. So what I will do here to get this, I will take the standard fixed overhead per whole unit, and then I multiply this with the budgeted output. I multiply this with the budgeted output. I'll multiply this with the budgeted output. So the standard fixed overheads per unit will be 640 every whole unit, which needs how many hours? 4 hours at 160 per hour. Every whole unit will be taking 640. Multiply this with the budgeted output. At the beginning of the period, how many units were we budgeting to produce? Budgeted output. Somebody talk to us. What is the expected output or budgeted output?
4,000.
4,000 given in paragraph number 2. The last sentence. The budgeted output and the sales for the month of October 2017 was 4,000 benches. 4,000 benches. So 640 times 4,000 is our budgeted fixed overhead. And I expect you great students to give me an answer. 640 times 4,000 will give us what figure? Somebody there. 640 times 4,000 will give us what figure?
2,560,000.
2560,000. Thank you very much. So then this will be 2560,000 minus the actual fixed overheads. So actual fixed overheads, throw your eyes to the actual information. Actual information given in note number 3, the actual fixed overheads. I'm able to see the actual fixed overheads figure of 19 what year? 60, the year that I was born. So 1960,000, yes.
Still has a question.
A question, yes.
Kindly explain how 640 is per unit.
640 is for a whole unit. That I'll be able to explain. Ladies and gentlemen, you see the costing that we have here. You can see we have our standard cost card. we have our standard cost card. Allow me to repeat this. I like questions. Questions really help us to learn more. So we have our standard cost card here. This standard cost card is normally given for one unit, for one whole unit, normally. For one whole unit here, which, for example, they have told you wood. Wood will be how many kilograms, for example? 25 kilograms, each at 32. So then the whole bench, the whole unit, in this case here, will be gobbling up how much? 800. The same case, ladies and gentlemen, here with fixed overheads. For fixed overhead, they've told us one bench, fixed overheads, they've told us one bench is 4 hours. And each hour goes for 160 per hour. So in terms of valuing a bench for fixed overheads, how much for one bench? You'll be able to see 600 what here? 640. So this is fixed overheads per unit of output. It's not per hour, because the valuation could either be for 1 hour, for one unit, or even if it's materials per kilogram, per unit. So this 640 is for our whole unit. There are students who prefer getting this budgeted fixed overheads this way. There are students who will tell you, Mwalimu, for us, we love getting these fixed overheads this way. They will come and tell you, Mwalimu, this is how we prefer getting our fixed overheads. They'll tell you, fine, fixed overheads is budgeted fixed overheads minus actual fixed overheads. But for budgeted fixed overheads, there is somebody who will tell you, Mwalimu, work with standard fixed overheads per hour. And of course, if I'm talking of standard fixed overheads per hour, I must come and talk about what here, the budgeted, what here now? The budgeted hours. The budgeted hours. So what they will do is to come and compute the budgeted hours first. And to get our budgeted hours, what we shall do, my great friends, what we shall do to get budgeted hours, what we shall do, I can see the labor hours in the standard card. I can see the labor hours were how many? 4. So these 4 to get budgeted hours, 4 hours for one bench, times the number of benches we expected to produce, number of benches we budgeted for. You guys gave me a figure of 4,000. So 4 times 4,000, this gives me how many budgeted hours? 16,000 budgeted hours. Then once I have that, I will come and plug in here. I need standard fixed overheads per hour. The standard fixed overheads, when you go to your fixed overheads in the card, you can see the standard fixed overheads per hour. We are talking about what here? 160. 160 times the budgeted hours. Budgeted hours are how many? 16,000. If you try that way, you'll be able to get this 60,000. If you do it that way, you'll be able to get that 60,000. I'm 100% sure of that. But you see, why should you go through all this trouble? And yet, there is an easier way of getting this budgeted fixed overheads. Take the standard fixed overheads per one unit, the 640, times the budgeted output. That simplifies everything. So I hope I've answered that student. Please feedback from that student. Are you okay? Thank you very much. Now, that now takes us straight away to the next type of fixed overhead cost variance called the fixed overhead volume variance. So fixed overhead volume variance, and unfortunately, you never gave me the answer for this. You guys never gave me the answer for this. Can you give me the answer for this? What do we have there, somebody? This minus 1960,000.
600,000 F.
600,000 F like that. 600,000 F. 600,000 F. 600,000 kilograms. From there now we can go to the next item called fixed overhead. Called here fixed overhead volume variance. The second one. This is B. Fixed overhead, the volume what here? Variance. Difference between two volumes. We have our budgeted volume minus our actual volume multiplied by standard fixed overheads for a whole unit, because these are units inside here. Actual volume. Actual volume. So this BV stands for budgeted volume or output. The budgeted volume, you gave me a figure of what here? 4,000. The budgeted volume, you gave me a figure of 4,000, ladies and gentlemen. And then we have the actual volume. This is the actual volume produced. Actual volume produced. So the actual volume produced, if I'm not wrong, we produced 3,600 benches. How about from the standard cost card, how about this standard fixed overhead for our whole unit? Could you kindly give me this figure? From our standard cost card, what about our standard fixed overheads per unit? Who is able to read this standard fixed overheads per unit from the standard cost card?
There's some are giving 640, others are giving 160.
Some are giving 640, others 160. Thank you very much for trying. That 160, just go to that 160 very well, read it very well. You will see it is 160 per hour, and I don't want standard fixed overheads per hour. I want standard fixed overheads for a whole unit, which should be 600 and what here, somebody? 640, please. So then this one here will be equal to what here? My budgeted volume is 4,000 minus my actual volume, which is 3,600. Multiply this by the standard fixed overheads per unit, which is 640. Like that. Please give us an answer. Give us an answer. So open bracket there, you say 4,000 minus 3,600 close times 640. What figure are we getting? What parameters are we getting there? What answer are we getting there?
Uh, 256,000 F.
256,000, 256,000 A. 256,000 A.
F, not A.
Oh, majority are saying F.
Yeah.
Is there anybody saying A?
Yeah, I can see someone by Noor.
Noor is saying adverse. Noor is saying adverse. Noor is saying adverse. Noor is saying adverse. Ladies and gentlemen, remember we have got variances we normally call exceptional variances, which we normally interpret in the opposite way. These exceptional variances, what do we have here? There are three. The first one is the fixed overhead volume variance. The first one is fixed overhead volume variance. Number two, we have what we call the fixed overhead capacity variance, fixed overhead capacity variance. And then number three, we have all sales variances. All sales variances. We have all sales variances. They're exceptional. Of course, being exceptional doesn't mean that they are difficult to compute. Being exceptional for us here, exceptional means that we shall be interpreting them in the opposite way. In the opposite way. In that case here, for the above three, if number one, positive. If positive, they'll be taken as adverse. They'll be taken as adverse. If negative, they'll be taken as favorable. They'll be taken as favorable. So if positive, adverse. If negative, favorable. Those three, they're exceptional. They'll be interpreted in the opposite way. And if you want even to make some reasoning, if you want to reason out to be able to agree with us, look at this variance. We had budgeted to produce 4,000. I mean, set up a high figure on the roof up there, produce 4,000. But when it came to actual, we underperformed. We produced less. As a businessman, you can't be happy. you can't be happy. Yes.
Mary Wambui is saying that she is confused.
Uh-huh. Yes. Really, it's about here. Look at this. Exceptional variances. I know somebody may say this is positive, which will give us what here? Favorable, which should have given us favorable variance. But now we have variances we call what here somebody? Exceptional variances. Exceptional variances are those variances that we interpret in the opposite way. There are only three. There are only three. In the opposite way, remember ordinarily, when it is positive, it should be what here? Favorable. But we are saying that for this, except this variance, ladies and gentlemen, where we shall be taking positive to be a bad thing, where positive will not be increasing my profits. Positive, according to these three, will be reducing my profits. There are three. You simply cram this. You simply cram this, and then, of course, you will be able to get as we get along. So look at this. We are the plan. Kama saa mwalimu hapa. Kama for example, right now, look at how I'm missing my targets. I was planning by this particular time, advanced MA, I was to be having about 200 students. 200 students. How many do I have at the moment? 92. So if I had planned for a bigger output, and here I am at 92, I mean, I can't be happy because smaller volumes, production volumes means what? Less income to me. Less income to me. So that will make me sad. Any variance which makes me sad will be what here somebody will be an adverse variance, will be an adverse variance. So are we together up to there? Is there anybody who has a question? Some of these things we get used to them as we get along. Now we go to the last variances called the sales variances. Sales variances are divided into two. Sales variances are divided into two. Sales variances are divided into two. Which variances are these? So I hope you have written there sales variances. Sales variances. We have sales price and the sales volume. Variances. Variances. Like that. Sales price and the sales volume variances. So we begin with the first one, which is the sales price variance. Which is the sales price variance. The sales price variance. Sales price variance, what do we have here? Sales price variance. Ladies and gentlemen, when we talk of sales price variance, this automatically shows me that we've got two variances there. We've got two variances there. Not variances, but we have got two prices here. Which prices are these? We have the standard selling price. The standard selling price minus the actual selling price. Standard selling price minus the actual. Minus the actual selling price. Minus the actual selling price. Remember, a variance is a difference. Difference between our expectation and the actual outcome. So we have the standard selling price minus the actual selling price. And then, of course, this will be a variance for only one unit. So outside here for totality, we need to come and multiply with the actual quantity that was done what here, that was sold. The actual quantity that was sold. The actual quantity that was sold. So ladies and gentlemen, if that is the case, come straight away and plug in the figures. Is there anybody from the standard card? From the standard card, is there someone who is able to see the standard selling price? What is the standard selling price? From the standard card, is there anybody who is able to see the standard selling price? Once they talk of standard selling price, I'll get this figure from the standard card. What is the standard selling price? 2,200. Is it only one who is giving me that figure? Mary, 2,200. Many 2,200 minus actual selling price. What is the actual? Please go to the actual information given in note 3 and give us the actual selling price. In note number 3, give us the actual selling price. From note number 3, what is the actual selling price? $22.50. They're giving me a figure of 2250. Do you know how they got that 2250? These are bright students. They know that for us to be able to get revenue, to get in this case here revenue, we normally take price times quantity sold. So they can see outrightly that from the actual information, the actual sales was 7,200. The actual sales, which is the same as revenue, was actually 7.2 million, which will be equal to the price that we don't know. But remember, for us to have earned this, we sold 3,200 benches. And therefore, if you make P the subject, it will be this divided by this. This divided by this, which I'm being told will give us what figure here? 2250. 2250 times the actual quantity not produced. These are sales variances. So it should be the actual quantity that was done what year that was sold. So at the end of the day, we did sell 3,200 benches. So could you kindly multiply for us, give us an answer? Kindly multiply for us, and then you give us an answer. So we have open brackets there, 2,200 minus 2,250 times 3,200. What do we have there?
160,000.
160,000. Is it A or F? Where?
F. Material giving F.
Material giving F, isn't it? One thing that those students have been able to remember very fast is that these are sales variances. This is like the abnormal disease, the exceptional things. Yes, when I subtract, it's supposed to be negative. Ordinarily, I would have said adverse. But because of the abnormality, because of the exceptional nature of a variance, I have to interpret it in the opposite way. Thank you very much. F, yes, F. F. Now from there, we go to the last one, which is the sales volume variance. Sales volume variance is the easiest variance to compute. Sales volume variance is the easiest variance to compute. Ladies and gentlemen, my sales volume, we're looking at sales volume variance being equal to what we have now here. Sales volume. We have the budgeted volume minus the actual volume. Budgeted volume minus the actual volume. And then outside here, ladies and gentlemen, we shall have what we call the standard profit per unit. The standard profit per, quite confusing. Whatever we are going to have outside here, ladies and gentlemen, depends on what really do they want us, what really do they want us to reconcile. If you look at the reconciliation statement that these guys are in need of in the requirement, second requirement, in the second requirement, these people want us to reconcile what here? Profits. A statement reconciling profits. So whenever they want us to reconcile profits, then outside here we must be having standard profit per what here? Per unit. Standard profit per unit. Standard profit per unit. Standard profit per unit. If they want us to reconcile contributions later on, we shall be talking of standard contribution per what? Per unit. But for now, because they want us to reconcile profit, let's have standard profit per unit. These are things we get to know. So the budgeted volume, we were budgeting to sell 4,000, but we actually sold 3,200. Remember, this is actual volume sold, not produced. Sold. It's a sales variance. Times the standard. Who is able to give me this figure of standard profit per unit? Standard profit per unit. What do we have there? Standard profit per unit. What do we have there? Standard profit per unit. What do you have here?
280.
Yeah, somebody is giving me a figure of 280. Thank you very much. 280. So please give me the final answer. Give me the final answer. Give me the final answer.
$224,000.
224,000?
Yeah.
Is it many of them saying A, or there are some who are saying favorable?
Many are saying A.
Many. Who is this who is saying favorable? But we shall overcome. Don't mention names here. We shall overcome. We shall overcome. We shall overcome. Now, ladies and gentlemen, we have been able to finish calculations of all the 5 types of variances. Now we can do a reconciliation statement. Yes.
Karuki is asking 208 how?
280 how? The 280, if you look at the standard cost card, you see he's talking about the standard profit per unit. If you look at the standard cost card, this table given there, before additional information, we have wood, we have labor, variable overheads, fixed overheads, total standard cost, we have selling price, and then we have the standard profit, which is 280 karaoke. 280. 280. So is that okay? Thank you very much. Thank you very much. Now mention there a reconciliation statement. Reconciliation statement. Mention there reconciliation statement. Reconciliation statement into brackets operating statement into bracket operating statement into bracket operating statement into bracket operating statement. So this operating statement, I will have my reconciliation statement looking like this. Reconciliation statement looks like this. We have the budgeted profit. Budgeted profit, what do we have for budgeted profit? Budgeted profit. My administrator is warning me that time is not on our side, so please let us rush through. But of course, in a way that you should be able to understand. So budgeted profit, how will I be able to get the profit which we are budgeting for? The budgeted profit, ladies and gentlemen, here we know that each unit is 280 times the budgeted output. Budgeted output, you guys gave me a figure of 4,000. The budgeted number of benches, you gave me 4,000 there. So please take 280 times 4,000, give us an answer. 280 times 4,000, give us an answer. 280 times 4,000, give us how much are we budgeting to earn as profit? How much are we budgeting to earn as profit? They're not talking. 1120, yeah? 1120,000. And then, of course, we know that in between budgeted profit and the actual profit, what do we have? Variances. So come and give us variances. Our variances, we have MPV, usage variance, labor rate variance, labor efficiency variance. We have variable overhead efficiency variance. We have variable overhead expenditure variance. We have fixed overhead expenditure variance. We have fixed overhead volume variance. We have sales price variance. We have sales volume variance. You go back to your workings and then you give us these parameters. You give us all these answers, and then of course they have to be in one line. So I'm giving you 1 minute, you copy this, and then you ensure that you have been able to put all these figures in one line. You can even put them immediately below this. That's below like the material price variance which you computed. Material price variance that you computed, if I'm not wrong, the material price variance that you computed with yourselves, we got 240,000 adverse. So come and write here, 240,000 adverse. So please, now you finish now. Write like that up to there. Finish like that. Finish. Gentlemen, come here. The next variance, after material price variance, we have material usage variance. Could you kindly give me the material usage variance? What figure do we have there, somebody? For the usage variance, usage equals. I'm waiting for the figure so I can finish very fast. Usage equals. Have they given us a figure, material usage variance?
320,000.
320,000 F or A?
F.
F, thank you very much. How about the labor rate? Labor rate variance. Labor rate variance, what do we have?
160,000 F.
160,000 what here?
F.
F. 160,000 F. But from ladies and gentlemen, we have labor efficiency variance. Labor efficiency variance.
Uh, 128,000 F.
128,000 A. 128,000 A. 128,000 A.
Next one, 64,000 A.
64,000 A. Thank you very much. And then
40,000 F.
40,000 F.
Yeah.
40,000 F. The next one.
600,000 F.
600,000 F. Thank you very much. I'm of course lost. I can't see these figures. So people want you to give me figures. I just finished writing.
256,000 F.
256,000 what here?
A.
A. Thank you very much. From there, we are doing well. Or have we finished all of them?
160,000 F. Next figure.
160,000 F. The next figure. Do we have any other which comes after this, or now we are through?
It's 224,000 A.
224,000. I'm being given a figure of 224,000. 224,000 A. Like that. 224,000. We have any other?
No. That's the last figure.
This is the last figure. Thank you very much. Now come and take 1120,000. Your calculators. 1120,000. This figure has to be subtracted because it's an reverse. So we have this minus this plus this plus this minus this minus this plus minus plus minus. Give us a figure down here. So you're seeing adverse, you're subtracting. Where you are seeing favorable, you're doing what you're adding.
Like between 1488,000 F.
1488,000. Like I can't say F or adverse. It's 1488,000 profit. So it's an actual. This is the actual profit. This is the actual profit. Actual profit, which is 1488,000. Like that. When you put an F, no problem. It still means that the thing is profitable. That's okay. So it's important that you get to see whether your figures are reconciled. Please go to the actual profit given in note number 3. Is there somebody who is able to, first of all, is it many of them who got this figure? Or only one? Many. Thank you very much. I would want to see whether I'm correct or wrong. I would want to see whether I'm correct or wrong, ladies and gentlemen. Go to note number 3. Note number 3 is strictly go to the actual profit. What is the actual profit figure given there? What is the actual profit given there?
1488.
1488, and because figures are in thousands, so it's supposed to be 1488 what here? 1,000. Hence, it means that we have done what here? We have reconciled. We have reconciled. We are correct. So in an exam, you know that straight away, all these marks, I'm okay. All the marks here, I'm okay. All those marks now, I am okay. I am okay. But what if, for example, ladies and gentlemen, you got a figure like 2,000? If you got like here 2 million, if you got something like 2 million, and then you go straight away to the actual income statement, you get 1488 there, meaning that you are wrong. In an exam, the moment you realize that you are wrong, what will you do? Ile ujanja ya maisha, survival. Once I get 2 million, what will I do? Nothing. You don't even try to go backwards yet to try to see which figure you are wrong. No. Remember, in exam, you only have how many hours? 3 hours. You only have 3 hours. You only have 3 hours. With the 3 hours, the moment you realize you are wrong in one, there must be another question ahead of you which you'll be able to score much more marks other than getting back here to disturb yourself, to disturb yourself, to disturb yourself, to disturb yourself. So I hope that has been helpful, but I want us to do more other questions in this particular area. Like this May 2016, question number 4B. May 2016, question number 4B, yes.
A question from Dan. Differentiate between input cost variances and productivity variances.
Okay, not a problem. When we go to the inputs, ladies and gentlemen, in some question which I know Dan is asking about, I'll be able to show you which are the input cost variances, like the ones which go into production there. And then, of course, we have the productivity, like the efficiency, etc., but that will come in later. That will come in later. For now, let us try to go through whatever that I've taught you here using the May 2016 question number 4B. May 2016 question number 4, boy. May 2016 question number 4, boy. May 2016 question number 4, boy. I'm specifically going to this particular question because they want us to give them a statement reconciling. So I want us to do this reconciliation statement once again. May 2016, question number 4B. So I would want us to go to Roman 2, where they want us to show all the operating variances. And the very first variance that I'll compute are the material variances. So what I want us to do today is to enter into some race. Let's get to see whether there are students who will be able to get material price variance and the material usage variance, and then today for sure, we give them a present. The very first students will be able to get the material price and the material usage variance within the time limit. Because when they tell us to prepare a reconciliation statement, they want us to calculate all this. So it starts with material price variance and the material usage variance. May 2016 is the question 4B. Let's see, you will be able to take the prize.
13,500. 11,000.
How many of them are able to get that figure?
Many.
Many students. So the first one that I'm being given is material price variance, which equals
113,500.
113,500. Adverse or favorable?
Favorable.
Favorable. And the very first student who got this figure goes by which name there?
Umaima.
Umaima got this. Very good. How about the material usage variance? Material usage variance? Nobody has gotten that yet.
They're giving 100,000.
100,000, quite huge, eh? 100,000 A. And that answer came from who is the first to get it right? Quite hard to pick, eh?
It's Edith.
Edith, eh? Edith. So those students who have been able to get that, of course, I know most of you got it right, but the very first students who got it right should contact me after class for their cup of tea, eh? Contact me after class for your cup of tea. Of course, you have my phone number. Now, ladies and gentlemen, is there somebody who was not able to get these figures? Is there anybody who was not able to get these figures, who feels that really Mwalimu should do them?
Maybe Nyakami.
Mary, says Mwalimu should do them. So what I'll do is to do the first one for you. The first one, material price variance differences between two prices. We have the standard price minus the actual price. And then outside here, we have the actual quantity of materials that was purchased. So this is standard price per kilogram. When I go to my standard cost card of EXA, we are told up there standard marginal cost per unit. You can see direct materials, how many kilograms? 6 kilograms, each at 40 per kilogram. This is standard price per kilogram. So it should be 40 minus the actual price. Go to the actual information. Actual information, note number 5 is where they're giving us the actual results. Actual results. The direct materials purchased and used were 113,500. But you see, these kilograms there, they have gone ahead to give us the total cost, not the price. So I need to take 44.26. I need to take 44.26. I need to take 44.26. 500. Divide this by the number of kgs, which were 113,500. 113,500, 113,500. And then, of course, this will be in brackets times the actual quantity kilograms that were purchased again from the actual information. Note number 5, they purchased 113,500 kilograms. Maybe if you try to compute this, you'll be able to get that. I'm so sure most of you problems started here. You know, this is actual price per kg. What you have here, find it's an actual price, but for many units, for many kilograms, you have to divide by the number of kilograms. And then we have this, the last one for today, before I run out of my time, is the material usage variance. Material usage variance is SQ minus AQ multiplied by the standard what here? Price, multiplied by the standard price. So capital SQ minus AQ multiplied by the standard price. Remember, this is standard quantity for actual production. Standard quantity for actual production. So I'll go to my standard marginal cost. I'm able to see direct materials. The standard quantity there is 6. But remember, the standard quantity given must always be multiplied with the number of units that were actually produced. So you can see units of X are produced. From note number 5, the actual production was 18,500. 18,500. Minus, please let this not get lost for you, this is supposed to be the actual quantity of raw material, because we're talking about material, actual quantity of raw material that was used. The actual quantity of raw materials used from note number 5, direct materials, I can see we used 113,500. Into the standard price per kg, throw your eyes back to the standard cost curve, where you are able to see that the standard price is 40 per kilogram. So times 40 like that, you should be able to give us an answer. You should be able to give us an answer. So please help us there. You'll be able to get us an answer, and for that matter, very fast. Otherwise, I'll take this opportunity to really appreciate you. Please keep on working hard. Keep on working hard. Now that most of you have decided to combine sections because of this grace period of examination, registration, which has been extended, let us just work very hard. I would want to see our WhatsApp group being more busy than it was before. So I would want to see, like now, this kind of a question. After say an hour, I would want to see students flashing answers there. And then, of course, as usual, as we do it, I'll be able to go through and then I have advice. Now we cannot, if we are doing 6 papers, if we tend to do 6 papers in September, end of September, we really have to be up on the game. We have to be up on the game. So otherwise, thank you very much. And I hope these lessons are adding value. I hope they're adding value. When you see that there is no value addition from this mzee, you tell mzee, kaa kando kidogo, leta vijana barubaru. Lakini kama zina add value like today's lesson, and to believe it has been helpful. Thank you very much. God bless you.